Insurable interest in real estate homeowners insurance refers to the financial stake or ownership interest that a person or entity has in a property that justifies them purchasing insurance to protect it. This concept is crucial because, in order to take out an insurance policy on a home, the policyholder must have an insurable interest in that property. Simply put, the person or entity must stand to suffer a financial loss if the property were damaged or destroyed. Insurable interest is important because if the owner of the property named on insurance policy dies, and something should happen to the property, the insurance company is going to send the check to the name that is on the insurance policy. If that person is deceased, you will have a problem cashing a check and getting the property fixed. For more good information, get a copy of KISS Public Claims Adjuster Study Guide. It has helpful information for homeowners as well as good information for people that want to be a public claims adjuster. You can get your copy from Amazon.com at the link below. Key points about insurable interest. 1. Financial risk. To have insurable interest, you must face a risk of financial loss due to damage to the property. For homeowners, this is straightforward because they own the home and would suffer a loss if the property were damaged or destroyed by a covered event, like fire, storm, or vandalism. 2. Ownership and control. In most cases, homeowners have insurable interest because they own and control the property. The interest can also extend to people who hold a financial interest in the property, such as mortgage lenders or others with a lien against the property. 3. Mortgage lenders' insurable interest. If you have a mortgage on the property, the lender also has an insurable interest. Lenders usually require that you carry homeowners insurance to protect their financial interest in case the property is damaged or destroyed. In case of a claim, the insurer will pay the lender, at least the outstanding loan amount, first, with any remaining funds going to the homeowner. 4. Who can have insurable interest? Homeowners, the person who owns the property has an insurable interest, meaning they can insure it to cover the potential loss. Lenders, mortgage companies or banks that provide financing have an insurable interest to protect their investment in the property. Tenants typically do not have insurable interest in the structure of the home but might have an interest in their personal property, contents, for which renters insurance is often recommended. 5. Why it matters. Legal requirement: insurance companies won't sell a homeowner's insurance policy to someone who doesn't have an insurable interest, as it would be deemed an improper or fraudulent contract. Claims processing: if you have an insurable interest, you are eligible to file a claim for damages to the property. However, if you no longer have insurable interest, for instance, if you sell the house or if the lender's lien is paid off, you cannot maintain the policy in your name. How insurable interest affects your policy. 1. Policy validity. Your homeowner's insurance policy is valid only as long as you maintain an insurable interest. If you sell the property, you must notify your insurer, as you would no longer have an insurable interest and the policy would need to be cancelled or transferred to the new owner. 2. Claim payouts. When a claim is filed, insurers will determine if the policyholder has a legitimate insurable interest in the property. If they do not, the claim may be denied, or the payout may be limited to the extent of the insurable interest. 3. Mortgage lender requirements. If you have a mortgage, the lender may require that the insurance policy list them as the loss payee. This means that in the event of a claim, the insurer will send a portion of the payout to the lender to cover the remaining balance of the mortgage. In summary, insurable interest ensures that only those who would financially suffer from a loss are able to buy insurance on a property, preventing individuals or entities from profiting off of someone else's property damage. It protects both the property owner and lenders, ensuring proper compensation for losses and maintaining the integrity of the insurance system.